All right, good morning, everybody, and welcome to our second ALTA Insights webinar, How COVID Has Impacted the Housing Market. I'm Steve Gottheim, ALTA's General Counsel, and I'm going to be our moderator for today's session. And so thank you all for joining us, and thank you to Qualia for sponsoring today's webinar. These days, it seems like real estate and the real estate economy is taking a cue from a Dickensian play or something. It's the best of times, it's the worst of times. You know, on the one hand, we continue to get news out of the Mortgage Bankers Association that purchase mortgage applications are at an 11-year high. And then on the other, we get news yesterday from the National Association of Realtors that home sales in May fell to the lowest seasonal average since October 2010. And so, who knows what to expect for the rest of the summer? Who knows what to expect for the rest of the year? But that's why we are lucky today to have somebody here who's going to hopefully give us a little bit of a view into what we might be able to expect. So please welcome with me today George Wright-Tude. George is a senior economist at Realtor.com. George explores trends in global economies, real estate markets, technology, and consumer demographics and investments. Prior to joining Realtor.com, George managed research programs at the National Association of Realtors, focusing on housing statistics, U.S. and international, and then commercial real estate market performance. In addition to providing economic and industry insights as a regular columnist for leading real estate publications, George is a well-traveled keynote speaker across the U.S. and Canada, and also a familiar face on a number of media channels, including the Wall Street Journal, Bloomberg, ABC News, CBS News, the New York Times, USA Today. If they broadcast anything about the housing market, you've probably seen George on it. He's a member of the National Association of Business Economists and the National Economists Club. So I know George is got the right information and is going to give us a great overview of kind of where we are today and kind of where we might expect the housing market to be going in 2020 and beyond. Before we get started with George, I just want to kind of do a couple of quick housekeeping items. First, a big thank you again to Qualia for sponsoring today's ALTA Insights webinar. Second, as you have heard at the beginning, all of participant lines are muted for today's presentation. If at any time you have a question, please submit them in the chat box on the right-hand side of your screen. We do have time set aside at the end for Q&A, and so we will do our best to get to your question during kind of that last part of today's webinar. Lastly, you can find a copy of today's presentation and the slides that George is going to reference in the handout section. It is, again, on the right-hand side of your screen, so you can take notes and follow along as we go along. After today, we'll have this webinar recorded, and it'll be going on demand on our on-demand website at alta.org/webinars. So with that, let me please welcome, and everyone join me in welcoming George Wright-Tude. Thank you, George.
Thank you, Steve, and it's great to be here with you as well as the other members of the association. And you're absolutely right. Your opening was perfect. It is exactly one of those situations where I think Dickens is appropriate, right? The best of times, the worst of times. So I'll do my best to read the tea leaves, as it were, from what we're seeing in the market. For anyone who's on social media, you see my handle up there. Anything that makes me sound intelligent, please reference it. If you don't like what I have to say, try the @other George Wright-Tude just in case. Anyhow, so moving to the next slide, here's what I'm going to be focusing on this morning. A brief overview of the economic environment as we see it right now, followed by a more in-depth look at some housing trends that we have uncovered during this turbulent period, and then a short look at what we expect for the remainder of this year, and of course the Q&A. So as we move to the next slide, you'll have to probably agree with me that when you woke up on January 1st of this year, you were not expecting that come June you would be looking at a market, an economy, an environment as we have today. And in fact, to me, and perhaps this photo of a thunderstorm might not even be fully appropriate. Maybe one of a hurricane would probably be more appropriate to sort of illustrate the depth and the scope of what we have experienced, right? So as we move to the next slide, it is for I know all of you, you've been immersed in the constant media stream of information. The pandemic has been global in nature. Every continent, just about every country has been impacted with really significant numbers. I mean, this is something that when you look at the fact that we've been in this roughly 3 months, you can tell that the health impact has been really, in a sense, extremely strong. And just as importantly, the economic response has been um, unprecedented on in terms of scale and speed. So as we move to the next slide, what we basically can see is that the pandemic has already impacted economies across the globe. And what I have here for your review, you can tell starting at the left, the United States, the Euro area, China, Japan, Canada, and then a host of European countries following with some of the Central, South American, as well as a few Asian countries. You can tell it's really a sea of red to a large extent. Economies around the world have paid quite a price. In many respects, I said unprecedented. We've never had a time where we shut the economy, and in fact, the global economy, we've shut it down purposefully to preserve health and safety for people. So that obviously has significant spillover effects. And in fact, the International Monetary Fund this last week just further downgraded their expectations for global growth. Their April forecast called for a 3% decline in global GDP. They actually expect it to be a lot worse. And as we go to the next slide, it's worth remembering that what I have here on the, especially the chart on the right, that pie chart, I have the top 50 global economies by nominal GDP. And you can tell that over half of the global activity is obviously concentrated in the United States, China, and the Euro area. All three of these regions very strongly impacted by the virus. And just as importantly, from our perspective, every one of these top major areas very interconnected in terms of business activity, in terms of trade and global connection. So obviously, whatever happened in China, beyond just the virus, but economically speaking, from a business activities, is impacting the United States, and whatever happens in Europe is also impacting both of those regions. And so obviously this will have a long shadow for the remainder, not only of 2020, but also into 2021. The silver lining to this, as we move to the next slide, has been the fact that on the monetary side, we have seen a coordinated and really large scale response. Starting with the Federal Reserve, you may remember back March 3rd, the Fed basically announced a surprise 50 basis point cut in the interest rate, and then it just basically snowballed from there in its response. It was the first major institution to signal that this was going to be a much bigger concern than what initially we might have expected. And as you can tell on this chart, whether it's the US, whether it's the Euro area, Bank of Japan, Canada, even Bank of China, this chart is slightly outdated by a few days. Bank of China has taken a much more accommodative monetary stance. All central banks, by and large, have resorted to either zero or, in some cases, negative interest rates to pump a lot of liquidity into financial systems to make sure there are enough funds in the financial system to prop up business activity and, by extension, obviously, economic activity. And for the U.S., at least the Fed obviously has gone all in. Not only have they moved down to 0% interest rates, they committed basically to purchase assets, including mortgage-backed securities. They are obviously resorting to purchasing corporate bonds. Again, a lot of unprecedented moves, both in terms of speed and scale. So as we move to the next slide, what we see is that in the US, the economic response was swift. You tell on the bar graph to your left, for the first quarter 2020, we saw a 5% drop in gross domestic product. The initial estimate was 4.8, revised later down to 5. What's noteworthy about this is, think about the fact that it was really the last 3 weeks in March that were responsible for that particular decline, and it's obviously the steepest since the Great Recession. And not surprisingly, right, when we basically ask all of us collectively to stay home to obviously maintain health in an economy that's mostly driven by consumer spending, that's going to have very sudden and broad ramifications. And obviously we've been living with this for the last a few months. Some of the most really high level impact, as we switch to the next slide, obviously has been in the area of employment. We saw the response right away in the airline industry, in the hotel industry, the restaurant industry, all these frontline industries that deal with consumers basically felt this thing right away. And you see, I basically mapped on the sort of the large bar graph. You see, going back to January of 2007, you see the little dip during the little only by really comparison to the recent one, Great Recession, where we had a significant number of unemployment claims. It really looks like a tiny mound compared to this recent March, April, and May impact on jobless claims. You can tell that they really spiked to unprecedented levels. The 13-week total is obviously over 46 million. The number of Americans still drawing unemployment benefits is about 21 million. Obviously, some of the people that lost jobs early on either returned to their previous jobs or they found others. So not all of the 46 million that filed claims are still unemployed, but about 21 million still draw unemployment. Significant number. I mean, really looking at the speed of this, to me, it's what's been the most surprising. So moving to the next slide, what we're seeing, actually one slide before this one, what we're seeing is really, again, to me, the what's notable about this chart is historically speaking, every time I used it, you were able to see the bars pretty clearly. Well, compared to what we saw in April of this year alone, we're almost off the scale. It almost makes the chart seem to lose its detail. And what I have for you here is, when you look at the 2010, January 2020 through December 2019, the net number of jobs the US economy created was about 22.2 million. So a 10-year span, we practically wiped out that gain in 1 month. In the month of April, when we lost almost 21 million jobs. May provided a surprise with actually a gain of a few million jobs. So if anything, to me, that is promising. It tells me that, and a lot of that gain, basically half of that gain, was in the restaurant and hotel industry. So a lot of those folks return back to their jobs, but we're likely to see the effects linger for a little bit longer. And as we switch to the next slide, I wanted to see which particular sectors of the economy suffered obviously a lot. What I compare for you here is, in the gray bars, you can tell the 2010-2019 period. We had nice widespread employment gains throughout most sectors. However, in April and May of this year alone, you can tell the red bars, we have had significant losses, and many of those, not surprisingly, as I mentioned, heavily centered in leisure and hospitality industries, the retail trade, right? Think about all the stores that had to close, whether it's clothing stores, electronic stores, anything that was not obviously a grocery store, or depending on the state and the quarantine requirements, a restaurant obviously was closed. And also, I think importantly, you can tell the local governments have been feeling a lot of pain too. With decreased business revenue, with decreased travel, a lot of revenues that come from tourism and conferences to local governments have actually evaporated. That's putting a lot of pressure on local government finances and of course on employment. And so I expect that to actually linger, particularly as we look forward at what seems to be a very adjusted schedule of business with cautious reopenings. So moving to the next slide, obviously all these had an impact on the unemployment rate. We saw its jump up to 13.3% in April, actually 13.3 in May, a slight decline from April. I have here both the main unemployment rate in the light gray, what the economists refer as a U3, and I also included, because I think it is very relevant in today's environment, the unemployment rate that also includes folks that are marginally attached. So those that are part-time or underemployed for economic reasons, what economists refer as a unemployment 6. You can tell that on balance, we're looking at 21% unemployment rate by and large, which when we're going to look at housing, I think this will be something to keep for perspective in mind, because it obviously will impact the markets going through the rest of the year. So switching to the next slide, one of the areas of concern, particularly in sort of the April-May timeframe, was the fact that there were a lot of Americans that were literally living on the financial edge. This was based on a survey from University of Chicago, a research center. And you can tell pretty clearly that the folks who could miss, no paychecks before having to dip into savings was fairly elevated, 30%. Even those who could miss one paycheck was still elevated at about 20. So it told basically all of us, as well as policymakers, that there were a lot of folks who were in need of immediate help. And we saw a lot of legislative and regulatory response to that. Some of it with the paycheck relief, some of it with boosted unemployment benefits. But just as importantly to me, on the regulatory side, the fact that we saw regulators take action to prevent foreclosures, to prevent renters being basically kicked out of their homes was an important action. It provided that very critical bridge in this chasm that opened right in March. It was pretty obvious from the experiences we witnessed in China and Europe that we were looking at a 2.5 to 3 month period of lockdown. And so it was obvious we needed to provide a bridge for a lot of us, really collectively, for that gap period. And if there's any good news in today's housing market, and I'll touch a little bit upon that, the reason we're not seeing massive foreclosures, prices haven't dropped, that regulatory response has as much to do with it as anything. So going to the next slide, what we found as we looked at the situation carefully, however, was the necessity to dip into saving is likely to stunt housing activity very likely over the next few months. One of my colleagues, Nicholas Beto, looked at what the necessity to take money out of savings to pay rent could mean for particularly millennial buyers, right? So we have 5 million millennials turning 30 this year. Tremendous number on a demographic front, because it's a time when most of them are looking at buying a home. They are either have or are starting families, they're having children. Critical time for housing market, and a tremendous boost from a demographic standpoint to activity. Well, it turns out we calculated that if a typical millennial has to take money that they've saved for a down payment to spend on 1 month of living expenses, it will take them 9 months to recover the amount of money from that 1 month of spending, and the numbers grow exponentially from there. If some of the folks, millennials, have to, let's say, pay for 3 months of rent plus living expenses out of their savings. If they live in a high cost area like San Francisco or New York, they are looking at potentially several years having to spend recovering. So obviously this is an important thing to keep in mind. Now, looking to the next slide, we have seen, thankfully, Americans respond quite dramatically to the shift. And what I have here for you, going back to 2010, is the savings rate. And you can tell I have the gray line showing the average over a long period, going back to 1959. So over the last decades, half a century, the average savings rate in the U.S. has been about 9%. We saw that spike a little bit in 2012, but it's been sort of running a little bit below trend for the last 10 years or so. And then came obviously April, and the savings rate jumped to over 30%. It's obvious that consumers responded pretty quickly to the change, but obviously this left a lot of concern as we move to the next slide for is our collective confidence. You can tell consumer confidence as measured by the conference board had a pretty dramatic drop in April and May, not surprisingly. So with these high level views, let's turn to housing. And as we move to the next slide, I want to point out that in terms of housing sentiment, this procession is this dramatic, obviously, decline in economic activity, the shutdown, in a sense, of the economy by government decree, took a toll on housing sentiment. And more recently, when we look at May data, you can tell that there's very much a difference in how buyers and sellers feel about the market really in this period. And this comes from Fannie Mae and their housing sentiment index. When they ask buyers, is this a good time to buy? 52% in May said yes, it is a good time to buy. At the same time, when they asked the respondents, what about selling? Is this a good time to sell? Only 32% of respondents said yes, this is a good time to sell. So clearly, when you look at mortgage rates, very favorable. We're hitting breaking historic records on the downward trend. But even with that, consumers, particularly sellers, are very uncertain about the current market environment, and that shows up as we move to the next slide in our inventory data. So when we look at the number of active listings on Realtor.com, you can tell that there's been a downward trend, which in a sense started about the midpoint of last year. Why? If you remember, the beginning of the year, we expected interest rates to go up, and then in a sudden surprise, mortgage rates began to decline about June of last year. That spurred demand. So we had a lot of buyers come to market, and they began, in a sense, drawing down on listings. But um, on top of that downward trend, what the pandemic did is really accelerate that drying up of inventory. When you look at the first 2 weeks in March, yeah, we already had a decline in total listings, but new listings were actually on an upward trend. You can tell sellers back in March were actually putting homes on the market. We had 5% year-over-year change in new listings. Compare that to this last week we are now tracking on a weekly basis data. New listings were down 20%. And in fact, that decline had been at about the same rate for several weeks, has actually accelerated total listings on a downward trend. So in fact, total listings are shrinking at an accelerating pace. And of course, buyers and depending on where you're located in the country, you have very likely experienced this in your own market. There are still buyers out there for various reasons. People have to move for work, right? In many cases, people are changing jobs. When they change jobs and locations, they look to buy. Other people have had plans, whether it's retirement or something else, and they obviously want to carry on with those, so they're buyers in the market. What there's not enough of, there are not enough sellers. So as we move to the next slide, we're seeing that decline in listings be particularly acute in large metros. And I do recognize that this particular chart, depending on your on your bend, it's either a Rorschach test or an optometrist, chart, or maybe one of those 3D visual puzzles that you might have seen back in the late 90s, early 2000s. So my apologies for the small font, but the what's worth focusing on is the lower right-hand corner. You can tell as we moved into the pandemic period, places like New York, Milwaukee, Philadelphia, Pittsburgh, Los Angeles, San Jose saw a steep decline. And mind you, these were also areas which were impacted by the pandemic. But what's significant about the decline in new listings, as we move to the next slide, we looked at the relationship between new listings and existing home sales, and they are significantly correlated. And what we basically projected for the rest of 2020 at the current pace, and making a few assumptions about seasonality, right? We have high activity in the summer, and then things taper off in the fall and winter. We expect this steep decline in new listings alone to cut home sales for the year by about 15%. And that assumes that the situation doesn't get any worse. So moving to the next slide, as I mentioned, seller reaction is very much linked to the density of cases of coronavirus cases. You can tell that in the top metros with the lowest pandemic cases, in the inventory was down 37% year over year back in April, whereas the top 10 metros with the highest COVID cases, new listings were down 69%. So naturally, as you'd expect, market participants adjusted to what they perceive to be the reality in their markets. So obviously, and not surprisingly, the number of contract signings took a nosedive. When you look at the chart, basically in April, we saw the contract signings drop to the lowest index value that the National Association of Realtors has recorded, going back as far as they have data, as obviously consumers stayed home. And with those contract signings, moving to the next slide, obviously on pause, existing home sales also dropped. And what I mapped here for you are both existing in the dark bars as well as new homes. And you can tell that both existing and new took a tumble. This morning, Census released data for new home sales, and in a positive note, and that did not make it since I finished this chart last night. We saw new home sales as of last month actually increase. Now, the census had to revise downward the April numbers, so that it plays a little bit of a role, but both on a month over month as well as year over year, new home sales rebounded, which to me is encouraging. But you can tell on the existing side, we registered steep drops. And this coming from a market that in the early part of the year, January, February, was actually ahead of trend compared to a year ago. So we really were primed to have a very good year. But obviously this has altered that trajectory. So moving to the next slide, it just as importantly to the housing picture is the credit availability focus. And what you can tell here, this is mortgage credit availability, the index from the Mortgage Bankers Association. What we're seeing is a combination of factors. Even though mortgage rates are very attractive, what lenders, and obviously you are keenly aware of this, what lenders have done, concerned about the worsening economic environment, and more importantly, with high unemployment, they're obviously worried about borrowers' ability to repay their loans. So they pulled back on mortgage availability in various ways. A lot of banks are requiring 20% down payment. In addition, for a lot of lenders, particularly large lenders, they have basically begun to restrict applicant pool to a FICO score of 700 and above. And when you look at where we were prior to COVID, the minimum down payment was somewhere in the 5 to 10% range on average, and the credit score was around 680 and above, which in and of itself was already a higher credit score than we had prior to the last recession when we were around 620. To me, the positive thing, and as we switch to the next slide, or the silver lining maybe in this, is that average FICO scores have been on a strong upward curve. You can tell this comes from Experian, that FICO scores over the last decade roughly have been moving steadily up as employment improved, as people's incomes grew, as the people basically paid down debt. You can tell credit scores reached really a new high at 703 last year. A little bit differently depending on obviously the metro area. You can tell that in places like San Francisco, credit scores were well into the 700s. Same for Denver, San Diego area. Some other parts of the market like Las Vegas, Riverside, the Orange County area were a little bit below that. But on balance, consumers were in a much healthier position. Where this, however, becomes a lot more nuanced as we move to the next slide is in the age demographics. And this is key, as if you remember, we are having 5 million millennials. And the millennial generation, we talked a lot about this generation over the last 10 years, right? A lot of stereotypes. It was the generation that was never going to own anything. They were going to rent everything. Well, it turns out, yes, when they were, all 24 years old, they were not really worried about owning much of anything. But the oldest millennials this year are turning 39. Many of them have children. They're obviously in sort of moving towards the middle stage of their lives. And so with that, they're very much a stronghold in the housing market. When you look at FICO scores for these age groups, the 20 to 29, so the younger millennials, have FICO scores near to 650, and the 30 to 39-year-olds are at 673. Both groups still below that 700 threshold, which really, when you think about housing, when you think about, again, going back to those, not that all 5 million of those turning 30 this year would necessarily choose to buy a house, but obviously a large number of them would obviously contemplate that. So the fact that mortgage availability is being restricted, and FICO score being one of those, is likely to have an impact on overall sales. And moving to the next slide, that's significant because as of a year ago, millennials are really the driving force in housing markets. You can tell that by share of mortgage originations, the blue line that's near the top is the millennial group. You can tell they are the dominant force. They make up over 50% of housing activity this year, followed by Gen Xers at some distance, and of course much lower baby boomers. And what's interesting about millennials, moving to the next slide, because of economic conditions over the last decade, because of, and you've heard this discussed before, student debt levels, they have basically entered housing in a very different position. For one, they are now matching baby boomers in purchase price. So they're actually buying bigger homes, right? They're paying more money because they're buying bigger homes as their families are growing. At the same time, however, their average down payment has actually been smaller. When you look at the chart on your right out of that spaghetti, the blue line right above the purple one are the millennials. You can tell that their average down payments are below those of the Gen Xers, baby boomers, and even the earlier silent generation. So obviously this is impacting, even in a healthy market, this would obviously have a certain impact, but especially so in the current environment. Now, we've all been through, several months of quarantine to various extent, depending on which state you live in. We've all had to not only work from home, but cook at home. If you have, school-age kids, teach at home, work out, at home, just about do everything at home, which has certainly, I think, changed how we relate to our homes, how we see our homes. So as we turn to the next slide, we at Realtor.com were curious to see how has that impacted really the home for us and our preferences. And we asked in an April survey consumers across the country, what did they find during this pandemic period as the most important feature of their current home? And you can tell that at the very top, a quiet neighborhood or property was near the top. Not surprisingly, if you have to conduct business meetings, Zoom calls, webinars, and so on from home, having a neighborhood where you don't hear a siren or lots of noise during the day is obviously very important. But so is outdoor space, whether it's a patio, whether it's a yard, green space. Obviously, we've discovered that the need to be outdoors is crucial to our health, our mental well-being, and that of our families. Also, close proximity to grocery stores, pharmacies, very important, followed by, now that we've been cooking at home a lot more than we envisioned probably when we purchased our homes, a nice kitchen updated appliances near the top. The other things that to me stood out, natural light, ample storage, a spare bedroom, flexible spaces, very important, especially if you know that if you have kids, the flexibility of space, right, has played an important role. Now, we followed that question up and asked consumers, what would you change in your current home to make it more livable? Number one, more space. Number two, update the kitchen. And number three, not surprisingly, add a home gym. In fact, to me, this is a real red flag for a lot of gyms across the country and gym companies. It seems that perhaps for a while, a lot of their business model might be impacted. So turning to the next slide, we follow these questions with what would you do differently? What sort of features would you want in your next home now that you've gone through this pandemic period? And you can tell right away, number one, for most consumers, they want more space in the house. With cautious reopening, with really work from home policies now being either extended or made permanent across many companies, we are seeing our homes have to evolve to be not only a shelter during off work hours, but now really a sort of a centerpiece to our work life. At the same time, more and better outdoor space. We obviously have discovered, especially if you live in a high dense urban environment, that the need to be outdoors in green space is paramount. Also, updated kitchens and more and better technology, faster Wi-Fi, smart home features. Also, you noticed on the chart, separation from the neighbors, very valued, along with more bathrooms and additional rooms with doors inside the house. What this tells me is we're likely to see an acceleration of a trend which we already saw in the last 2 years, and that being a migration from highly dense urban neighborhoods towards suburban and mid-sized cities. And I think if anything, there's a real opportunity for home builders and for activity in the suburbs here. And what I have on this chart, you already began to see this migration begin to take shape in the early stages, right? March, April, people started looking, this is based on traffic to our website, people began to look away from their metros pretty quickly. In the largest 100 metros, and you can tell this includes places like New York, San Francisco, Seattle, you can tell that during the pandemic initial stages, people just stopped looking, right? You see a sharp drop, but then you see the rebound. So, and that's intensified. In fact, in places like New York City, a lot of potential buyers are already on our website looking at places. And you will see in the next few charts where they're looking. And here you have New York City. They are looking away from Manhattan. And more importantly, when you look at the map, thank you, Steve, for advancing it, you can tell that the northeast area is a center point for a lot of buyers in Manhattan. Right around New Jersey, Long Island, Connecticut, but just as much, buyers are beginning to look all the way out into the northeastern part of Pennsylvania. They're looking in upstate New York, Albany, Troy, Buffalo, and even in some cases all the way along the eastern seaboard. You can tell Virginia, the Carolinas, Georgia, particularly Atlanta, and all the way down into Florida and Miami are all top targets for New York City buyers. So obviously this pandemic is going to put a damper on what we've seen in terms of development in the urban core, the urban renaissance. But I think this will obviously spell a lot of benefit to the suburbs. Now, a counterpoint to this, and we move to the next slide, is Seattle, another major city which had an early start to the pandemic. You can tell Seattle also registered a decline, followed by a slight spike and then a much sharper drop. So it turns out that buyers in Seattle, unlike those in New York City, didn't necessarily feel their city was worth leaving. So when we look at the next slide, where are buyers from Seattle looking for their next home? You can tell there's very strong concentration in the Northwest. In fact, Portland and Oregon was a very strong target area, Salem, Oregon. So Seattle buyers very much focused on the Northwest. The only exception seemed to be, and you can tell Dallas there at number 2, Texas. And there's a natural link there. Think of the fact that the Seattle area, the Northwest, very solid home to technology companies, whether it's Microsoft or Amazon. Um, and when you think about what we've seen over the last 10 years, mainly the dispersion of technology company campuses across the country, Texas has been a major beneficiary, both from their treatment of taxation as well as very pro-business friendly regulations. They've attracted a lot of companies, whether it's Dallas, whether it's Austin, Houston, and you can tell that basically for a lot of people from Seattle, the state of Texas is a very viable and desirable alternative to Seattle. So turning to the next slide, what I wanted to focus a little bit on, the fact that in terms of housing demographics, as I mentioned, millennials and Gen Xers are driving the housing market this year, millennials especially so. And that will look very differently depending on what metropolitan area you're focused in. As we jump to the next slide, I just picked Chicago for an example. Those of you who live in Chicago are obviously going to recognize the neighborhoods and the zip codes quite well. You can tell by the generational cohort that the areas where people are buying very much differ. For millennials, you can tell it's fairly widespread. There are people buying downtown, there are people buying out in the western suburbs at quite a distance, and even into the northwestern Indiana. Gen Xers who have been in their profession longer, whose financials are much stronger, and obviously who have children who are older, you can tell the northern northwestern suburbs are very much on the menu for them. For baby boomers, they're beginning to move out of downtown cores, much more towards the farther out suburbs. And Gen Z, the youngest folks, and of course this generation is just beginning its trajectory, they obviously are very much driven by value. You can tell they are much more active in outlying areas where it's a lot more affordable. Similarly, as we move to Dallas, again, I picked another city, you can tell similar trends in Dallas where Gen Xers are pretty much spread throughout the Metroplex, millennials much more focused on key areas close to downtown, boomers towards the outlying areas, and of course Gen Z looking for affordability. And with that, I wanted to move into the outlook. What do we expect the remainder of 2020 to look like? And so as we move to the next slide, we started the year, and you can tell the middle column, 2020 original, expecting a pretty decent year. Our expectation for gross domestic product was about 1.8%. We expect the unemployment rate to go up a little bit from 2019, but stay quite low at 5%. So a lot of the indicators at the first part of the year went out the window. In fact, we are looking at a negative growth in GDP, right now projected at -3%. We expect the unemployment rate, of course, it spiked in April. It's beginning to come down. We expect it to level out somewhere around 10% for the year. But all the other major economic indicators we expect to obviously take a major hit. And as we move to the next slide, that's no different for housing. In fact, what you see there is our forecast of sales. We expect the sales to basically be down. And in fact, we expect them to follow sort of a W-shaped recovery, depending obviously on a few assumptions. We expect to see a slight rebound in the summer, and we're already seeing some of the signs of that in terms of traffic at the very least. I think new home sales, this morning's new home sales were an indicator. Existing home sales will probably see a similar rebound. After being cooped up, those who still have jobs, those of us who still have to make moves are obviously going to try to capitalize on these really low mortgage rates. and that's great news. But then we're going to move into the second, latter part of 2020, colder months when generally traffic slows down for weather and other reasons. We expect to then see a continued a relapse before a much stronger rebound in 2021. Moving to the next slide, however, I want to point out that in terms of beyond this year, what is a realistic outlook? And really, I want to leave you with this graph, which is the US population broken down by demographic cohorts. What to me is significant is over 50% of the US population, in fact, over 60% this year, is under the age of 50. That's a tremendous position to be in for an economy driven by consumption. The fact that we skew younger, the fact that we have so many young people coming through the life stages, of course, millennials and then Gen Z, tremendous numbers of young people, for me, spell also tremendous potential, both in terms of economic growth as well as technological progress, but just as much for real estate. This is a tremendous potential for market activity going forward. And so really for the remainder of this year, for me, from sort of the economic perspective, I want to keep a close eye on what happens to employment. A lot of people who lost their jobs early on expected to get those jobs back, and many of them have. However, there is a spillover effect, whereas the early companies to feel the pressure were airlines, restaurants, hotels. Now we're seeing broader business services companies, we're seeing manufacturing companies, technology companies beginning to feel the pinch and announcing layoffs. So if we can avoid a prolonged period of high unemployment, I think we'll be in a good position come August. At the same time, I'm keeping an eye, of course, on what happens. This being an election year, we're seeing a lot of activity on the legislative regulatory side to make sure that things are obviously providing a smooth foundation. For me, what happens to forbearance, what happens to the rent forgiveness period come August, September will also be a telltale sign. And ultimately, regardless of your choice come November, the December and January period, I think, will be a much clearer indicators of how we're positioned for 2021. So moving to the next slide. If you're looking for any more information or similar research, we track data on a weekly basis. We provide daily commentaries on our Twitter feed. So looking for any more resources, you have a bevy of information on our research portal, data library. We put up a COVID-19 resource page. So any information you're looking for, lots of it. And with that, I turn it back to Steve and would be glad to answer any questions.
All right. Thank you, George, and thank you for such a thorough and really interesting conversation. As a reminder, we do have some time left over for questions. If you do have a question, you can submit it in the chat box on the right-hand side of your screen, and we'll get to them as they start to come in. It looks like our first question that's come in deals with a topic you kind of just touched on right at the end there, George, which is the forbearance foreclosure delays or the forbearance period. The question asks kind of what should we expect if this forbearance period doesn't get extended much further past the 12 months in the CARES Act, and so is that are we really just looking at a whole bunch of foreclosures that were delayed from 2020 into 2021, or do you believe that that those foreclosures aren't going to happen? And then if the forbearances do lead to foreclosures, what impact do you expect that to have on the market?
That's an excellent question. And I'll start by saying that I think that the regulatory move to provide forbearance was very much informed by the 2008 experience, when we had the massive wave of foreclosures, followed by a few legislative attempts at mitigating it. From my perspective, this is a good thing. I do know that it obviously puts some pressure on mortgage servicers, but considering that this recession, since we are in a recession, really wasn't born out of an economic necessity. It was really a recession created by government intervention to obviously address a health concern. I don't expect that the economy on overall would necessarily respond for a prolonged period. Initially, that was the expectation, for a prolonged period of time would negative. And in fact, most people, I think, still expect that be a reasonably quick rebound. So I think the 12-month period in a way buys homeowners enough time to sort out what their employment, because ultimately that's what it boils down to. Will you still have a job in the next 6 to 8 months? And if the answer is yes, then obviously this simply allows you to remain in your home and then catch up on your payments over the remainder of your loan. Um, right now, that's my expectation. Looking at the fact that yes, unemployment spiked. Yes, it's going to take longer than we initially expected. It's going to be longer than the 3 months we expected. But I have a feeling that we'll sort. And why? Why do I say that? Think about economic activity. What drives it? It's you and it's me spending money. Whether it's we go to the grocery store, we buy a new car, we buy clothing, we travel. Clearly, we're going to do a little less of that over the next 6 months. But once we get a better sense of what the viral activity is, especially come fall, it's very likely that we'll adjust accordingly. We're already seeing right now economic activity begin to rebound. Many of us are already going out to eat, yes, very differently in social distancing environment. So my expectation to your answer is we're not going to see over this next year an increased number of delinquencies. However, if the repercussions, obviously and understandably, linger beyond that without any regulatory intervention, yes, you're right. We could very much see a wave of foreclosures, a delayed one, come 2021. The negative obviously is that we're going to have Americans go through that process. At the same time, right now there are a lot of young buyers. To be honest, I've talked to, who are baffled at the fact that we're in a recession. They're looking for a home, and if anything, prices are continuing to rise because there's not enough supply. So anyway, my hope is that for a lot of sellers, the current environment where there is demand is going to provide them an incentive to bring product to market.
Perfect. Right, so our next question goes back to the forecast for 2020 that you had a few slides ago. But what does your forecast does your forecast currently take into account the possibility of a big spike back in the fall, or how might it change if there is another big spike, in October, November?
So right now we're looking basically at a scenario in which the number of cases continues, yeah, right there, perfect, in which the number of cases continues to remain manageable. So that does not, the forecast you see there does not include a noticeable spike, or a significant resurgence, which according to some health experts is a distinct possibility. So for now we're not projecting sales to be based on that, which is why we expect, in fact, June, July, so this month, July and August, to see a boost to sales. Sadly, we won't know, June's activity until July and so on. So it'll be September before we really have a full picture of how the summer looks. But no, the short answer is we have not yet modeled a spike in that. That's simply based on seasonal trends and our projections of sales.
Another question coming in asking about the DC market and how do you think that's going to fare for the rest of this year, and whether or not, if depending on how the election goes, we should expect a sale boomlet maybe in December.
Very, very good question, particularly for folks who live in the DC area and who are very attuned to the political cycle. So the market so far has been, from my experience and looking at the data, fairly level. In fact, for a lot of agents in the DC area, it's they're in fact they are saying that they've been as busy in the last few months as they've ever been. In terms of, there's obviously demand, particularly because DC area, as you know, is home to the federal government. It's nearby several major military bases. So there's always migration in and out of the area for work reasons for a lot of folks living here. So that generates its own wave of demand. So I think that will continue to position the market well for the rest of the year. For a lot of folks who are looking in this market, however, the frustrating thing has been that prices, even with lower mortgage rates, prices remain stubbornly high. So the tight inventory obviously is driving the market. So oddly enough, it's very much a seller's market, even though for many sellers, they are reluctant to put their property on the market in the current uncertain environment.
All right. Our next question kind of deals with the topic of interest rates and refi. So the question asks, with this kind of refi boom that we've just had, does that have any forward effects in terms of locking people into their homes for longer than they normally otherwise would stay?
Very insightful question. And I think that is very possible. In fact, I would say that in 2019, we were already looking at that as a potential a really side effect of when we looked at the shrinking inventory, we saw that as a potential cause of that symptom. Um, the fact that over the last 10 years, people have bought, and even prior to the current extremely low rates, people had bought their homes with 3.5% mortgages. And so for those folks, assuming steady state on the employment side, trying to buy a new home, number one, with a higher price, um, and even at the same mortgage rates, obviously would change their financial situation. So now, even more so, when you're looking at mortgage rates in some cases below 3%, I think that going forward, while we expect rates to remain low for the remainder of 2020 and even into 2021, when you look at the Federal Reserve's commitment to low rates, when you look at the general dynamics in the bond market, um, just judging by the 10-year Treasury, mortgage rates should be much lower than they are. So even in this environment, to the question itself, I would absolutely consider that a distinct possibility for many buyers who are already buying a home that might be a stretch for them, given the current high prices. The really low rates will likely lead to some lock-in effect. What I don't have a clear picture at this point is what share of the housing market will feel that. So that's the big question mark.
Okay. So looking at, again, millennial home buyers, and you talked about buying bigger homes than maybe they would normally have, than past generations might have bought. Is the trend with those bigger homes more towards buying bigger homes that are turnkey, or are they looking for flips or at least redos inside when it comes to buying homes?
Great question. So what we've seen, at least based on survey data, is for a lot of younger buyers, sort of a move-in ready home was much more preferable to a flip. And I think if anything, the home and garden television, right, HGTV, had a significant influence on that, right? Having seen all the Property Brothers and the Chip and Joannes and some of the other shows basically turn older homes into sparkling move-in ready, whether it's a chic modern farmhouse or craftsman style suburban abode that's 5,000 square feet. um, Clearly for a lot of younger buyers that has had an effect, and they generally have tended to prefer move-in ready homes. I think if anything, that will continue playing a role, especially in the current environment. Why? There's simply not enough existing homes available for sale. So I think the real opportunity here is for home builders. As we see this migration away from urban downtowns towards suburban environments and even smaller mid-sized cities within commuting distance, there's obviously a lot of opportunity. There's more land available, it's cheaper to build, and you can also build larger homes. I think there's tremendous opportunity in the new home space for builders. But yeah, I expect, frankly, to see millennials prefer newer homes, even as some of them will obviously spring for renovation. But I see investors being a lot more active in that space. In fact, even this year, there's a lot of activity in places like Cleveland, Nashville, where investors are moving in, scooping up homes that need rehabbing, and then flipping them or basically position them as investment properties. So I think those folks will play a much bigger role in that space.
All right, and it looks like we've got time for one more question. So why don't we turn it to a topic that we didn't cover in this presentation, because we focused mostly on the housing market here. But how, in general, what are you seeing on the commercial side of things in terms of, are people ever, going to be buying office buildings again, given that no one's ever going to work in an office anymore?
That's an excellent question. And in fact, I'll start by saying I don't think the office is dead any more than if you remember, there was after the recession, the suburbs are dead. Well, long live the suburbs. So the office right now seems to be dead. So, give it a year or two, we'll probably say long live office. If anything, I don't think that human nature will change so dramatically. Meaning, we are social beings. We enjoy each other's companies. We work well when we share same space with other people. In obviously the current health environment, that has to change and adjust. So I think we're going to see a lot of sort of mix use on the part of companies. They'll use some office space, but they'll also keep some of their employees on a flexible work from home or even permanent. So I do see a tempering in terms of demand absorption for office space over the next few months, the remainder of 2020. I'm still split on 2021, partly because if people return to the office and we need more space, we're going to see actually an increase in the number of square feet that a company might need in a building. So that's still up in the air for me. I'm not so bearish on office. To me, the one standout, industrial. Industrial has fared fantastically with e-commerce, with most of us now ordering everything just about online, whether it's Target, Walmart, Amazon, you name it. I see industrial space and warehouses, distribution centers, especially around urban areas, faring fantastically. Retail, lots of pain. There's no way to rephrase that. And then for multifamily, for apartment, I think still very strong outlook going forward, partly because with population growth, with price of housing being so high and in many markets unaffordable, there's lots of room for apartment demand.
All right, perfect. And certainly that can be an entire another webinar in and of itself. But I do want to say, since we are at the top of our hour, thank you to George, and thank you to Realtor.com for providing us some great insight today. I thank you to all of you who attended live on our ALTA Insights webinar. Hope you have a great Tuesday, a great end of the month, and as always, you'll be able to check back and watch this webinar again on our webpage, alta.org/webinars, or see any of the other sessions in our ALTA Insights series. Thank you again, and have a great day.